For most of my career, the easiest market in banking to predict was the core systems market. Very little moved, but that's about to change. Hi, everyone, and welcome back to Next Move Banking. I'm Virginia Heyburn, Principal Strategist with Engage FI. It's a fact of bank technology. The same handful of providers have dominated the landscape for decades. The same contracts got renewed, the same conversations happened year after year. And the safest prediction anybody could ever make was that whatever core a bank was running today, they'd probably still be running it 5 years from now. That's what made this market so unusual. In an industry obsessed with change, this was the part that barely changed at all. Innovation happened around the edges of core, think digital, payments, risk management, and I don't think that's true anymore. Now, in this episode of Next Move Banking, I'm going to put 5 predictions on the record. They're not trends, they're not possibilities, they're predictions. 5 calls about how I think the core banking market will change over the next 3 to 5 years. Am I right? Am I wrong? Let's talk about it. Each of these predictions gets its own focused episode in a series of episodes that I'm going to drop every week. And today, I want to give you the headlines. Before we get into the predictions, I want to start with the assumption underneath all of them. Everybody keeps treating what's happening in the core banking market as a technology story, and I don't think it is. Technology is where the symptoms are showing up first, but the real story is economic. For 40 years plus, many banks stayed where they were because moving was too expensive, it was too risky, and frankly, too painful. The technology wasn't good enough to justify the disruption. The disruption was not worth the reward, so most banks stayed put, and they innovated around the edges. But what's changing isn't that technology suddenly became magical. What's changing is the math, and when the math changes, behavior follows. So that's the lens I would use to think about every prediction I'm about to make. So prediction number 1, the ledger stops being the place where banks compete. My first prediction is just that. The core system of record increasingly becomes a utility. Now, before somebody clips that sentence standalone and sends me angry emails, let me be really clear. I'm not saying that the core doesn't matter. Of course it matters. The ledger matters. The system of record matters. But customers don't wake up in the morning hoping that their bank has a marginally better batch processing engine. What they experience is responsiveness. They want that to be better. Decision-making. They want it to be faster. Better service that's more in tune with their needs, their wants. So relevance. Can you give me more of that? The value keeps moving higher up the stack. So out of core system, much closer to where that customer experience is taking place. And if that continues, so does the margin. I think that the institutions that win over the next decade won't necessarily have the newest core system. They'll have the strongest intelligence layer that sits right above it. Why I think it's happening and what it means for an institution your size is where this series will start next week. Prediction number 2. It's the one that I think most people underestimate. AI breaks the lock-in from the inside. For decades, the thing that froze this market in place wasn't technology. It was the cost of change. I said that before. Conversions could take years, conceivably. Projects ran into the millions. The risk was high, and that created a very effective moat. What's fascinating is that the thing starting to weaken that moat is not a challenger core. It's 2 things. The cost and risk of conversions coming down because of discipline and skill around conversions. That is, of course, exceptional now, and that's a proud plug for what we do here at Engage FI. But then the second part of that is artificial intelligence. In many cases, it's the incumbent providers themselves deploying it. When the cost of understanding, migrating, and modernizing these legacy environments starts coming down, then the economics that protected the old model start changing too. And so, of course, the moat doesn't disappear overnight, but it doesn't have to. It just has to get shallower. And I think that's exactly what we're beginning to see. I'll show you the evidence in the episode on why this market is breaking open right now later in this series. Stay tuned for that. Prediction number 3, and this is the prediction that is actionable right now. Data rights become the most important clause in the contract. Real-time access to your own data becomes one of the most important terms in a core contract. And I don't think most institutions are negotiating that nearly aggressively enough today. For years, we've negotiated around price, and I understand why. But increasingly, price is not the strategic issue. Freedom is agility, flexibility in the architecture. Can you access your data when you want it? Can you use it where you want it? Can you build intelligence on top of it without somebody charging rent every step of the way? The institutions that lock in portability and access now are going to have many more options later on that other financial institutions simply won't have. And that's where competitiveness comes in. A lot of institutions are going to discover that their future intelligence strategy was determined years earlier by a contract that they barely discussed. Now, how to actually negotiate that term is in the episode on building the intelligence layer. Prediction number 4. The cost trap claims real victims. This is the prediction I hear the least discussion about in the marketplace. We need to talk about it. Everybody is saying how quickly AI costs are falling. That's true. But cheaper doesn't always mean less expensive. Storage got cheaper, and then companies stored more. Bandwidth got cheaper, and then companies transmitted more. The same thing, I believe, is happening here. As intelligence becomes cheaper, institutions are going to use more of it. There will be more monitoring in real time. There will be more decisioning, more automation of processes. Think agentic AI. There will be more models, more of everything. And I think some institutions are going to discover that even though the cost per decision went down, the total bill went up. And the winners won't be the ones that avoid consumption pricing. They're going to be the ones that govern it, because cost per decision is going to matter a lot more than most people realize. The full economics for the providers and for you is going to be in the finale of this series in a few weeks. Prediction number 5, the real risk is not talent, it's waiting. And this is probably the prediction I feel strongest about. The story community financial institutions keep getting told is that they cannot participate in this AI transformation because they just don't have enough technology talent. And I think that story is about to break. Here's why. The intelligence layer doesn't get built the same way a core conversion got built. You're not standing up a data science department. You're assembling it from managed components, vendor services, models you configure instead of construct. The talent bar for getting started is falling, and it's going to keep falling. So here's my actual prediction. The institutions that fall behind will not be the ones that couldn't hire enough data scientists. They're going to be the ones that waited, the ones who treated this as a someday problem until someday became too late. I'm not saying talent doesn't matter, because it does. What I'm saying is that talent stopped being the thing standing between you and starting. The thing standing between you and starting is the decision to start, and the gap between the institutions that move and the institutions that wait is not going to stay the same. It's going to widen. Every quarter you wait, the bank that didn't get a little further ahead, that's going to be the issue. I make the full case for that one in the payoff episode with a scorecard you can take into your own boardroom. So there they are, 5 predictions. The ledger stops being the place where banks compete. AI breaks the lock-in from the inside. Data rights become strategic. The cost trap catches people off guard. And the real risk turns out to be waiting, not talent. All 5 of these point to the same conclusion. For decades, advantage in banking was something you accumulated. More branches, more assets, more scale. But the next advantage looks really different. It's not something you own. It's something that you build. And more importantly, it's something that keeps getting better. So over the next 5 episodes, I'll show you why I think that's happening, where I think the value goes, and what I think institutions should do about it. I'm Virginia Heyburn, and that's your next move.